Hey, welcome investors to the 40 Finance channel. My name's Jeff Beers. Today I got a huge list of growth stocks. We're going to go through it by mega, large, and mid-cap companies. These are all profitable companies that are expected to grow both their revenue and their EPS in 2021 by at least 20% on both sides. So a lot of exciting things to look at today, including a list of big names that didn't make this growth stock list for 2021. Reminder, as always, that my stock picks and projections, they're just my opinion for your entertainment. Please make sure you do your own research before investing in any stock. And if you do enjoy researching and analyzing stocks, as well as talking about personal finance topics, then please make sure to subscribe to the 40 Finance channel and give this video a like. It really helps me out. Thank you to everybody who has supported the channel so far. And finally, if you're interested in joining the 40 Finance email list, link in the description. I will send you my 15-minute stock analysis guide as soon as you sign up. So check out the description to sign up today. All right, before we go through all the stocks, I just want to review some parameters here so we all understand exactly what data we're looking at. Our growth stock list today features companies that are expected to have plus 20% revenue and plus 20% EPS in 2021. Number two, it is important to note that this is all analyst projections. This is not my math. These are pulled mostly from Yahoo analyst sources. So that's where these projections come from. Number three, note that each stock has its own timeline. So while we're projecting 2021, fiscal calendars run different. So this 20% growth could take all the way to December, which would be over a year from today. Some of them would end in June as far as the fiscal year goes. So there's different time periods because every stock has a different reporting structure. Next, we're only going to talk about the stocks I know. This is not a comprehensive list. I did pick apart the names that I recognized. So just know that there are other stocks out there that meet these requirements. I just try to take the big, most popular names. And keep in mind, even though these companies have great growth rates or anticipated great growth rates, this list does not include considerations such as debt load or bounce back candidates. I think debt load's pretty obvious. Bounce back would be somebody who had a horrible year last year, could be because of the pandemic, and they're going to essentially do a normal year, right, in 2021. So for example, if you're down 20% in the year 2020, then you're up 20% in the year 2021. That's basically flat over 24 months, right? Not exactly what you're looking for. So you will have to do your research across the board. This is more just like an interest list to get you thinking about names for you to dig in deeper. All right, let's dig into the mega size market cap names. This chart, I think, is pretty self-explanatory. We are going to spend most of our time on these last three columns: estimated revenue growth, estimated EPS growth, and rate of return. If you invested $1 today, this is the rate of return is the projection on what you would make at the end of 2021, including dividends if applicable. So keep that in mind as we look through this. So going mostly in order of market cap, I see that Amazon and Google got switched. But here you can see that we'll start with Amazon, the second line. They have a revenue growth estimate of 25. EPS of 37, so things are starting to get more profitable with Amazon. And the rate of return is estimated at 15. Google, you've got 20% on the revenue, 24% on EPS growth, and rate of return of 22. Skipping around just a little bit to call out some oddball numbers. Zoom obviously went from nowhere to rocket star this year, and you can see that their revenue growth is in the 117, so 117% anticipated revenue growth. EPS growth of only 35% in comparison, but that's because this company is growing quickly, and I assume there's a lot more capital requirements to get them through the growth stage. But off to the side, the rate of return is minus 47%. Now, how could that be? Basically, what they're saying in here is this stock is essentially overvalued right now. So we look at the PE ratio of 578. That probably makes sense. Doesn't mean it's going to go down 47%. It just means that on historical valuation metrics, it is up there quite a bit. Same goes for Salesforce at -7%. And the big winner at the end on this board is Alibaba. Interestingly enough, though, Alibaba had a news headline today because the Ant Financial Group is being held up by China regulations. So it was to go live today, but it's being held up. So some of this might get distorted over the next couple of days because I think Alibaba is dipping down a little bit. But if you go across their revenue growth, 54%, that looks like the second highest on this board. EPS growth of 34% and a rate of return of 40%. So if you wanted to put all your chips on rate of return, Alibaba looks the most promising, but every investor would have a different way to look at this. I kind of like EPS growth because that's profitability and that ultimately brings your PE down. But there's more than one way to go about this. Quick note too, as I start to read through these names and I realize that I'm not going to be able to hit every single one, I will send this out to my email list so that you guys can have my raw data, which is just an Excel spreadsheet, and you can kind of look at it yourself. So just sign up for the newsletter below if you're interested. That will save us from me reading every single column on here. Okay, switching over to large market cap, and this does look like these are in order. Kicks off with Square at the top by market cap, and you can see Square, 50% revenue growth, 20% EPS growth. So again, they're growing faster. Now their rate of return, very interesting at -69%. I don't know if I believe that Square is going to fall 69%. But when you look at a high P ratio of 241 compared to some of the other players in the market, I could see it dipping some. But on the bright side for Square investors, you got 50% revenue growth anticipated, and that's only for 2021, right? And you got that EPS growing. Square just sort of turned profitable this year in 2020, so for them to add 20% to whatever EPS they land at is definitely a good sign. Who else we got here? Regeneron Pharmaceuticals, revenue of 39%, EPS of 20. That one gets a rate of return of 16. Let's just go down this rate of return column. Here's a 69 rate of return. That is for Horizon Therapeutics. Horizon Therapeutics, I don't know exactly what they are selling. It's obviously a biomed stock. I do not hold a lot of biomed stocks. So take a look at that one because you've got a revenue growth of 109. You got an EPS growth of about 40, and you got a projected rate of return of 69%. Now, one thing about this 40 in the EPS growth is for some reason there's a lot of stocks showing 40. So I don't know if that's just like a cap that if they're projected to go over, it just stops at 40. But just keep in mind that for some reason a lot of them land on 40. So you may have to do some of your own calculations there to feel really good about it. But Horizon Therapeutics, on the spreadsheet, it shows a decent amount of promise, to say the least. A couple names that I'd like to call out: SolarEdge Technologies, 57% revenue growth and 29% EPS growth next year, rate of return of 12%. And that's at a PE of 80, so it's not like it's dirt cheap. There was a lot of interest in my solar video that I did a month or so ago. And at least for me, walking off the street into solar technology and not knowing a super ton about it, I would probably be inclined to follow this SolarEdge lead a little bit to see if that would be the stock that I would play. A couple other notable names that do not currently have PE ratios, but apparently are projected to land in profitability next year: DocuSign, revenue growth of 39%, EPS growth of 27%. They do not have a PE today, so you get that NA column here. Looks like same goes for Zillow. Zillow, who I'm infatuated with, but still haven't found a price that I would buy. 60% revenue growth. they get that scary little 40 that we don't exactly know what that means on the EPS side. And since they don't have a PE today, you can't really calculate the rate of return using these metrics. But I really like Zillow. I just wish that it wasn't $100. All right, now we're going into mid-sized market cap. Let's see who's at the top here. Paylocity. You have revenue growth of 35%, EPS growth of 25%, but a negative rate of return anticipated for just the next year. That's probably this PE ratio at 157 and the sort of algorithm just calling out that that's a very high PE ratio, but it might be justified. You know, computers can't figure out everything when they run these metrics. And just know too that on this negative rate of return, we've talked about some bigger names. That's just for next year, and it is projected. So if your company blows out its earnings and prices for your stock come down, it's always in flux, right? So what looks like a negative rate of return today may very well be positive, 2 or 3 months from now. Looks like there's only one more negative. That's Beyond Meat. They don't have a PE ratio right now, so that's probably what's screwing this up. 164% revenue growth for Beyond Meat next year is really impressive. They get stuck with one of the 40s on EPS growth, so definitely do your own math. For some reason, the rate of return, they're calling negative 54%. And without going into detail on every single one, there are some really interesting companies here that I've looked at a lot in the past and would encourage you to dig into. Floor & Decor, Five Below, Lending Tree, Health Equity we've covered on this channel. CyberArk Software we've covered on this channel. Alarm.com, LGI Homes, that's a home builder. We're getting into a time when the world might be building a lot of houses, so I would definitely look at that one. Shake Shack is more or less like a fan favorite, but very interesting to see how strong their growth trajectory is. All right, so last slide today is our sort of notable no-shows. These companies here are not bad companies. In fact, these are probably the most popular companies to invest in the stock market right now. The only reason I carved them out here is because when people talk about growth stocks a lot of times, just to pick one, NVIDIA on this list, they would probably lump in that category. But at the end of the day, you really probably should have at least 20% revenue growth to be a growth stock. And, most people would probably start that cutoff line at 25%, to be honest with you. At the top of the board, though, is one of my favorites. A lot of you have been asking about PayPal. PayPal is fine, by the way. I know a lot of you were asking about them after the earnings report yesterday. They came in with slightly less than expected guidance for Q4. I think everything in that earnings report is exactly what I hope to see from a growth perspective. Please go and read it yourself or read some of the news storylines. There's not a lot to be concerned about there. From growth stock metrics perspective, we take PayPal, scan over, you got 17% anticipated revenue growth. They probably will beat that is my guess. EPS growth though of 20%, that's really good news for me and the way that I look at things. Rate of return projected at -8%. Some of that, again, is going to go back to this PE ratio, which is high right now at 86. Some of those numbers with PE ratio, though, are going to be updated with PayPal and others who release their earnings this week. So I anticipate that PE ratio to eventually go down here in the near future. All right, so let's talk about NVIDIA. You got PE ratio of 92, estimated revenue growth of 15%, EPS growth of 15%, rate of return projected at -20. And as I look, like Apple is next, and they're right in that same sort of minus category. The bottom line here is these are still good companies, and they're not going to go away. And this minus rate of return may come into play at some point in the year. But if you are a firm believer or you have a bullish thesis about one of these stocks, of why it will beat what people think it's going to do, then you may very well see a positive rate over next year's time. Mastercard and Visa both are in the same neighborhood, 12% revenue growth. Mastercard is going to win The EPS growth, 20% to 18%. Both of them expected rate of return in the early double digits there. Scrolling down real quick to see who had the highest rate of return in this particular slide. It looks like Cisco Systems at 21%. Their revenue is only going to grow 1.31%, but their EPS is going to get up to almost 15% growth. And you also combine a dividend with Cisco, and there you go at a 21% gain potentially for stockholders next year. Overall, on this slide of no-shows, though, you kind of see how the market is a little expensive right now because the sort of rate of return algorithm, if you will, is calling for some prices to drop. And most of that has to do right here in this column with P/E ratio. And even somebody like Apple, you see 33 P/E ratio, which seems good when you look at other companies. But, you know, Apple, Microsoft, Google, they've all been in that 25, 27 range for several years prior to this recent run-up. So that's probably what this rate of return formula is picking up on. All right, guys, so there you have it. A look at growth stocks for 2021, profitable growth stocks. If you're interested in receiving the spreadsheet, the raw data, not just the slides, sign up for my email list below. I'll send it out in a couple days, give you guys some time to see this video. Hope you enjoyed this video. Please give me a like and subscribe if you did. We will see you on the next video.